So you're making some good money. Your income has increased year over year. You're beginning to save a little bit, and now you want to upgrade your house, you want to go on bigger vacations, you want to start giving to charity, and these are all really good things. However, there are some really big pitfalls that you really want to watch out for, and hopefully I can shed some light on those and help you from making those big mistakes. My name is Ryan Hughes. I'm the founder of Bull Oak, and we provide financial advice to people who work hard. And today, I wanted to go over the 5 biggest mistakes that high-income earners make. Let's talk about mistake number 1. Assuming that your high income will continue indefinitely. Now, here is something that most people don't really know, that your income will likely peak whenever you're about 40 or 50 years old, and then it will slowly decline thereafter. So you have to watch out for this. You have to prepare for this. A lot of people tend to think linearly, meaning that they think that whatever the increase has been over the past 5 or 10 years, it's going to continue at that same rate indefinitely until you retire. And that's not true, especially if you're an entrepreneur. If you run your own business, or if you're in sales, or if you have some type of variable comp, you need to be really careful because your income can suddenly drop and you need to be really prepared for that. So ask yourself that one very important question: how steady is my income really? If you work in a biotech company, probably not that steady, right? If you work in sales and let's say 20, 30, 40% of your compensation is tied to some type of sales production goal, that's not very steady. So you need to save and put away for that rainy day, and you need to project out into the future and say, hey, my income is great today, but I've also got to be realistic and know that it's not going to stay this good forever. Lifestyle creep is another big component of this rule. Keeping up with the Joneses and spending high on really big mortgages and not really saving enough for your future is just another version of this, because you're in that mindset of where income is only going to continue to be this high or continue to grow at this certain rate, when chances are it's not really going to be doing that. Okay, so let's talk about mistake number 2, poor tax planning. Of course, as we all know, as your income grows, so is your tax liability. That's not a great thing. Nobody likes to pay taxes, but it's obviously going to be happening to you, whether you are a W-2 employee or if you're a business owner. Now, if you're a W-2 employee, you can do a lot of simple things to actually minimize your tax liability. While you don't have as many options available to you if you're a business owner, understand that there are some simple layups that you can do, like retirement plan contribution. Am I contributing to my 401k? Am I contributing to my deferred comp? Am I deferring to my HSAs to try to minimize my taxable income for that year? Now, if you receive any type of stock options, ask yourself these questions. If you receive incentive stock options, you have to ask yourself those questions. Are you spreading out your stock options to avoid AMT? Are you holding on to those ISOs long enough for that long-term capital gains, which is going to be 1 year from the date of exercise and 2 years from the date of your grant? Now, if you have any type of non-qualified stock options, are you filing that 83B? And are you holding that for more than 1 year until you actually sell? So as a W-2, you are limited with the number of write-offs that you can have, but taking advantage of simple things like this is really going to add up over the long term and hopefully minimize your overall tax liability. Now, if you are a business owner, obviously there's a lot more things that you can write off, right? Some of the easy layups are, do you have the right structure for your business? Are you filing as an S Corp or are you filing as an LLC? You know, there's a number of different things that you can do with that S Corp. Are you taking advantage of the qualified business deduction? Another thing that you can take a look at is, if you work out of your own home, are you eligible for that home office deduction? Of course, you need that proper retirement plan in place as well, like whether it's a 401k or a SEP IRA or even a profit sharing plan, you know, where you can deduct, you know, possibly hundreds of thousands of dollars if you're eligible for that. So take a look at these simple things, depending if you're W-2'd or if you're going to be a business owner, and talk to a really good advisor or talk to your CPA to see what can I do to minimize my taxes. All right, let's talk about mistake number 3 that high income earners tend to make, and that is buying illiquid assets. So once you begin to accumulate assets, it's a very normal thing to want to invest that money. That's good. You should be putting your money to work. But a very common misconception that a lot of people have are 2 things. One, as your income grows and as you start to accumulate into the millions of dollars, people think that you are now privy to some really inside deals, some really special investments that really aren't available to the general public. And there is an element of truth to that, but that doesn't necessarily mean that your returns are going to be any greater. Quite the contrary. Whenever you start investing in any type of private placement deals, or you start investing in any type of private equity or venture capital, what's funny is that the returns really aren't there for the end investor. A lot of that alpha that could be generated in these illiquid assets, if you know any type of investing, alpha is just that extra return above market gains. That's usually going to be kept by the managing partner themselves, that person who is actually brokering that deal. So 90% of the time, you would probably be better off just investing in a diversified portfolio. This is something that not a lot of people really want to hear, but it's just the simple truth. The numbers are out there, the data is out there. Just take a look at it and you will see that a lot of these deals really aren't that great. Now, of course, there's always those exceptions, and those exceptions are the ones that, make the rounds, or that these investors will brag about, or you'll see on the news. But you have to do your homework. If it's a real estate deal, just look at the vacancy rates, look what kind of cash flow is this thing generating? What is the track record of this manager? If it's a business that you want to invest in your friend's business, be very leery of it. Just, bottom line, do your homework and go in knowing that 90% of the time these deals really just don't pay out like you hope that they will. Another common problem with investing in these illiquid assets is that people tend to overinvest. And because these are illiquid assets, you're not going to have enough cash set aside for your future goals or even for emergencies, right? Life is unexpected, so you always need that cash set aside. So don't over-lever yourself by doing this. Okay, so let's talk about mistake number 4, and that is overworking. It's very easy to fall into this mindset where I've just got to be pushing, working. And that's great from a career perspective and for providing financial stability. But understand that you do have a life to live and you don't want to pass it up. And I have not a great story, but I think it's a very impactful story and I should share it. Early on in my career, I had a client who was a cardiovascular surgeon. He made very good income. He retired at the age of 60, and he was regularly working 70, 80-hour work weeks. And his goal was to obviously travel and take some time off, but he also wanted to rekindle his relationship with his 2 daughters. So he divorced from his wife, his 2 daughters. He didn't have the best relationship with them. And so during his retirement, he wanted to rekindle that relationship with them and try to amend somewhat. Unfortunately, a few months into his retirement, I guess ironically, he had a heart attack and he passed. And he never got that chance to enjoy the fruits of his labors, nor was he able to rekindle that relationship with his 2 daughters. And so, that's just a stark reminder that life is short. There should be some type of a balance to your life. Don't overextend yourself. Yes, it's okay to work hard, especially if you love to work. A lot of people enjoy working, whether it's your own business or for a company that you enjoy or for a cause that you enjoy, and that's great, but don't overdo it, right? Take some time off, take vacation, enjoy your family, try to find some type of balance in your life. Okay, so let's talk about mistake number 5. You tend to underspend. I know this sounds a little ironic, but we see it all the time within our business and our clients. People get into this mindset where they They save, which is great. Again, this is really good for financial security, but they don't spend their money. Or they spend a little bit of it, but they don't actually enjoy their money. And so they get caught up with just grind. I'm working and I'm saving and I'm putting money away in my 401k, in my brokerage account, I'm investing. But again, you're not really enjoying your life. So sort of like mistake number 4, where you are overworking yourself and not enjoying your life. Mistake number 5 is you are saving too much and not enjoying your life. Don't fall into this trap. And we see this a lot with people who are new to money. So if you grew up in not so great circumstances as a childhood, let's say your income was very low, you were impoverished, and you made your own life with your own 2 hands, which is great. Like, that's the American dream. That's fantastic. You see this pattern where you are just in this normal mindset where you are saving so much that it's almost just a shift in your own mind and your own lifestyle to actually spend some of that money. So you should. And I think what helps people get over this hump is just by looking at data. So ask yourself this question of, what am I actually saving? What is my target savings rate? So there's some of the metrics that we like to use with our clients to kind of help shift that mindset to enjoying some of your money here is your savings rate. So your savings rate is just going to be, what are you saving divided by your total income? And a good benchmark number is going to be about 25%. If you're saving 25%, again, this is just one metric and there's other factors to consider, but if you're saving about 25% of your income, chances are you're doing pretty good. If you're saving 30%, you're doing great. If you're saving 40, 50%, that's absolutely fantastic, but make sure that you're actually enjoying your life. If you are working every single week and you're not taking any vacations, or you're not upgrading your space, or you feel cramped, it's okay to do so. So another metric that we really like is what's called total term. So total term is a net worth calculation, and it's sort of a benchmark to see, am I on track for a comfortable retirement? And so what that's going to be is you're going to be taking your annual spending number divided by your total net worth. And so you measure this in years. Let's say you divide that and you get a number of 30, which is a really good baseline number to retire on. If you have 30 years, that means you have a net worth of 30 years to live off of, assuming no growth in your portfolio or your net worth or inflation. It's just a very simple metric. But again, these are back of the envelope numbers that you can look at. Just kind of say, am I actually on track for a comfortable retirement? And if you are, and if you are saving good, then you should consider enjoying your money. Don't penny pinch too much. Enjoy your time here. Okay, so in conclusion, it's a great thing if you are making good money. You've worked hard and you have a great career for yourself. Just don't assume that your income will continue indefinitely. Make sure that you are planning for taxes and that you are doing the right deductions if you can. Have a tax plan, and don't start to invest in assets that will tie up your money or give you poor returns. Again, don't overwork yourself and enjoy yourself. If you can afford it, splurge a little bit and enjoy your life. And if you have anything that you would like to add to this list, please let me know. We would love to incorporate suggestions in our future episodes if we can.